Put simply, indexing is an investment strategy that aims to match, not beat the market. When you buy the whole market with index funds and ETFs, you participate in the growth of local and global economies. The stock market goes up accordingly, and you get your share of that. And an index benchmark is a list of securities like shares or bonds representing the whole market or a segment of the market. You might be familiar with indexes like the S&P ASX 300 index, which tracks the 300 largest listed Australian shares, or the US S&P 500 index, which tracks the top 500 listed US shares. An index fund attempts to replicate an index as closely as possible by investing in the securities that comprise that index. So when you invest in the whole market through broad-based diversified index funds and ETFs, you get exposure to growth of local and global economies. For example, if you look back at the last 50 years of growth in the Australian economy, if you were invested in an ASX 300 index fund or an ETF, you would have received your share of those market returns. In contrast to indexing, we have active investing. Vanguard defines active investing as any investment strategy that's trying to outperform an index over time. That's trying to beat the market through stock selection or market timing. An active fund manager might do this by picking stocks they think are going to outperform, or timing the market by jumping in and out at just the right moment, or focusing on a concentrated sector, style, or theme. Active might sound like a smarter approach, but as we'll see, beating the market through stock selection and market timing is way harder than most people think. And one caveat here, Vanguard does believe active can play a role in many portfolios when it's executed well, but we'll save that discussion for another day. We're going to stay focused on the power of indexing for this video. When Vanguard launched the first retail index fund in the US in 1976, it was a truly rebellious concept. It was so counterintuitive that growth was slow at first, but with a lot of academic and data-driven support, indexing proved its worth and gradually caught on, leading to a massive shift in the way the modern world invests, kicking off what's called the index revolution. At the end of 2023, it's estimated that there's 30+ trillion Aussie dollars in index tracking assets under management globally. And for very good reasons, this number is only getting bigger. As the chart shows, global growth in indexing has been an almost exponential story, with a slow burn in the 80s and 90s, followed by a boom in the early 2000s. And closer to home, Vanguard is also proud to have launched the first Australian retail index fund. At the end of 2023, Australian index funds and ETFs account for more than 750 billion of assets under management. And that makes up about 25% of all Aussie domiciled stock and bond fund assets. And this may sound like a lot, but I want to point out that Aussie investors are lagging the globe. In Europe and the US, for example, index share of fund assets is roughly 1.5 to 2 times that level. So we have a ton of room to grow here in Australia. And something great is happening for everyday investors with the index revolution, and we need to help get the word out. So what's behind the shift to indexing? At the end of the day, the key to indexing success comes down to one thing. Let's talk about performance. As a numbers person, it's so important for investors to think about the base rate and probabilities. You could beat the market, sure, but what probability do you really want to place on that? Numerous practitioner and academic studies have shown us that most actively managed funds underperform their chosen index benchmark after fees over the long term. And one of my favorite performance studies comes from our friends over at the global index provider Standard & Poor's. And that report is called SPIVA, which stands for S&P Index versus Active. Every year, S&P measures active manager performance against their closest index benchmark, and it paints a compelling picture. This chart covers ASX large cap active managers for the last decade, and let me unpack it for you. It shows around 70% of Australian active large cap managers underperformed the ASX 300 after fees in 2023. You can see things move around a bit from year to year, but over approximately the last decade, an average of 62% of active funds closed or failed to beat the ASX 300. That's the green line. And we certainly see this active underperformance here at home on the ASX. But this is not just an Aussie phenomenon. The results are fairly consistent across Asia and the globe through the years, and we see it in bonds too. Those were one-year results, but importantly, longer-term, multi-year active results are even more discouraging. According to the Spiva report, roughly 80% of actively managed funds either closed down or underperformed their chosen benchmark index over 10 and 20-year horizons. So if you're investing over the long-term horizon, the fact is when you go active, you're much more likely to be in the long-term majority of the distribution that underperforms, the 80%, rather than the smaller percentage that outperforms, the 20%. Now, it's easy to think, well, hey, I just won't pick a bad active manager. I'll just pick from the good ones. Well, it turns out that's almost impossible to do. When we look at the data, the 20% of active winners turns over quite a bit. And what academics have found is that only about the top 2 to 3% of active managers have enough skill to repeatedly cover their costs, and the other 97% fall down below that. So these are your odds. The sense that you can get rich quick with active is intoxicating. But the fact is, beating the market turns out to be an illusion for most over the long term. So if only 2 to 3% of active managers can beat the market regularly after cost, and all other active managers occasionally outperform but usually underperform, going index and getting your full share of market returns starts to look really attractive, right? And because Vanguard and other index ETF managers aim to deliver the market return reliably and at very low cost compared to active managers, it just starts to make a lot of sense.